Welcome everyone to another episode of How to Make Money in Stocks with Investors Business Daily. It is that time of year again, so in the latest issue of the free IBD Extra newsletter, which just came out this week, we have a couple of easy-to-keep resolutions for all investors, as well as some stocking stuffer ideas.
And on the show this week, we're going to talk about moving average crosses in a pretty different way than we've ever approached them before.
Right, but first, let's take a quick look at the market.
It's been a back-and-forth week. Thursday was a rough day after European Central Bank President Mario Draghi expanded their stimulus, but at a lower end of forecasts. Now, the market really went into a tailspin, and the outlook changed to market under pressure. And we had the Fed in the mix as well. Janet Yellen issued some hawkish comments earlier in the week and after the new jobs report on Friday, in which 211,000 new jobs were created. It's almost a certainty that the Fed will raise interest rates.
There's been a lot of back and forth on that, but people seem pretty confident like it's going to happen. And here's what the NASDAQ chart looked like while all that was going on. We had some real Jekyll and Hyde action this week because Thursday we got another distribution day for the NASDAQ that was number 8. So as Amy said, the outlook changed to uptrend under pressure. But then on Friday, it seemed to bounce right back. And on the NASDAQ, we had a gain of over 2%. Big gain. But where was the volume? It was rather lagging. So later in the show, we're going to talk about moving averages for stocks. But look at the 50-day and the 200-day moving averages for the NASDAQ. The big question now is, will that 50-day get back above the 200-day, or will it just bump its head and fall back next week?
And by the way, some of Friday's action was probably due to short covering.
Right.
So that could have been part of it. Okay, on both the NASDAQ and even worse on the S&P, the sell-offs have come on big volume and the recovery has been on low volume. That's the exact opposite of what you really want to see. And the S&P dove below the 200-day, but they recovered on Friday and came back up above it. And also some of the distribution days have been compared to half-day sessions in the market, or selling has been a bit more mild, not fierce. And a lot of stocks are still holding up, although fresh breakouts and exciting setups are really kind of difficult to find.
They are, but there are a few out there. We had Ulta Beauty on Friday, nice breakout in that stock finally after a long time of really tight trading. And there are some other IBD 50 stocks that are setting up as well. For example, Starbucks. Starbucks is working on a flat base, and it managed to find support this week at the 10-week line. Now, for stocks like this, the key is really going to be the general market. If things pick up, the indexes take off again, they're probably going to go. But if they don't, it is like that heavy anvil sitting on top of them and makes it very hard for them to move higher.
It is. Now, Black Friday and Cyber Monday were huge. Shoppers spent $8 billion. E-commerce giant Amazon accounted for nearly 35% of all online sales.
$1 in $3.
That's
incredible.
Crazy. Best Buy came in number 2 with 8.2. Macy's was third with 3.4% of sales, followed by Walmart with 3.3%. And Amazon's Fire the tablet is now available in China. Amazon also has made an agreement with the Chinese internet services company Baidu to provide service, apps, search, online video services for the tablets, the Fire tablets in China. Now, the hoverboards are single-axle self-balancing scooters. I saw these in Vegas. These are crazy. They're hot sellers. They're not cheap. Over the weekend, eBay was selling one hoverboard every 12 seconds.
That's amazing. They are kind of cool. I had a neighbor going around on one.
They are cool,
so it's not too hard to get used to, but I didn't try it out. So we're going to take a look at Amazon's chart later in the show. And as we said, the uptrend remains under pressure, so you want to proceed with caution. But do keep an eye on leading stocks such as you've got Starbucks, LinkedIn, Qihoo, and others that are forming bases. And again, if the market does move higher, these stocks could take off.
Now, also showing strength are McDonald's, Facebook, Google, and Netflix. And Apple took a nice bounce off of the 50-day on some higher than average volume.
We often talk about the moving average lines that you find on a chart, but today we want to take a closer look at how you can use these benchmarks to see when a stock is showing renewed strength, and in some cases for some investors even spot an early aggressive buy point.
Now, when major moving averages signal a change and come back above some key areas, it's worth taking note. An example of this is the 10-week line, and when that comes back up above the 40-week line, this can signal a change in tone.
That's right. Now, here's an example with Amazon. It went into a long correction in January 2014, and note how the 10-week line fell below the 40-week moving average in April, and that reflects technical weakness. But then in February of this year, that 10-week line got back above the 40-week, and that showed Amazon was rebounding.
Now, Amazon popped higher the week of January the 30th on earnings and rose 13% for the week, and weekly volume rose 108%. And as Matt said, the 10-week line crossed back above the 40-week line. This signaled a change in character for the stock and showed more technical strength.
Now, note how Amazon was still working on a long consolidation at that point. So the 10-week line going back above the 40-week line was a positive sign. So was the very tight trading that followed that. And look how the 10-week line turned into a floor of support after being a ceiling of resistance in earlier months. So again, that was a telltale clue for what happened next.
And then Amazon zoomed up 18% the week of April 24th. Now the volume here, we go down, take a look at this, it increased 159% for the week. And of course, this happened because of earnings. And notice that the 10-week line now is nicely above the 40-week line. So when the crossover of major moving averages occurs, it's something for investors to make note of.
And of course, Amazon had a very nice run after that point. Starbucks is another example of how this works. Like Amazon, it went into a long consolidation, and in March of last year, the 10-week line fell below that longer-term 40-week line. But it got back above the longer-term moving average in July. But again, the 10-week line became a ceiling of resistance in this case. So it wasn't until it turned into a level of support that Starbucks started to climb higher.
Now then, the week of November the 7th, Starbucks 10-week began to move gently above the 40-week. And then it went on to form a flat base during December and January. And at this point, the 10-week was starting to move a little higher above that 40-week line.
So as you're evaluating this base at this time, you'd note how the 10-week line has stayed above the 40-week, and Starbucks was finding support at that 10-week moving average. And that was right before earnings. We always talk about how earnings is so crucial. So this was happening right before earnings in January. So in other words, the stars did seem to be aligning, and from there, Starbucks took off in a 40% run from that base.
Now, Facebook is going to be a really fun stock to talk about. It formed a double bottom base and zoomed higher the week of July 26th and vaulted 31% for the week on weekly volume that rose 192%. This is some powerful institutional buying money going into it.
And again, that came on earnings.
It came on earnings again. So Facebook finally reported these solid earnings numbers that we were looking for. Now notice that the 10-week line moves back above the 40-week, and the stock moved up 9 out of 10 weeks in a row.
And of course, since then, Facebook has formed multiple bases. And of course, it has also, for certain types of investors, flashed several sell signals along the way. But there are certain long-term investors that might look at how the 10-week line never fell back below the 40-week line. At least it hasn't yet. So personally, I wouldn't sit through that kind of volatility. I would take some profits and get in and out. But there are people who will look at that moving average, the 10-week staying nicely above the 40-week, as a sign of long-term technical strength.
And somebody who's more likely to do that is a fund manager.
That
would be a technical indication. If you're a fund manager, we have the ease of going in and out of the market. Mm-hmm. We have that's great for us to be able to do that. The fund managers can't do that. So taking a look at some of these moving average lines is the technical indicators that they really can use.
Absolutely.
And again, we're not suggesting, because Facebook has never, had that crossover of the 10-week line below the 40, that you would have automatically held. That's really not what we're saying. And it did form a bunch of series and pullbacks where, it made sense that you would have taken some gains.
Sure.
It would have made a lot of sense. But this is just a technical indicator that can help you out when you're evaluating stocks.
Right. So let's take a quick break, and then we're going to come back and talk about how some more aggressive investors will use the 10-day line as a sign to get back into a stock or to get into a stock to set up an initial position.
How would you like an edge that helps you pick winning stocks faster? An edge that is proven to outperform the S&P 500 by 76% since inception, and that you can take advantage of today without spending a dime. More on that in a minute. Each day, our top market team at Investors Business Daily scans our proprietary stock lists and screens to find superior stocks with the most potential for big gains. They analyze these stocks every step of the way to show you basis, buy points, sell signals, and the right time to take profits. It's about as close to hold your hand investing as you can get. Introducing Leaderboard by Investors Business Daily. For a limited time, you can try all of the premium features Leaderboard has to offer for a full 14 days at absolutely no cost to you. You'll receive unlimited access to all of the time-saving research, powerful investing tools, the leaders list, cut list, and expert analysis you need to develop a winning investing strategy. And it's all 100% free for your first 14 days.
In my book, How to Make Money in Stocks Success Stories, I interviewed a lot of investors who use IBD and the CanSlim investing system, but they may tweak it just a bit to suit their needs. Now, in the case of moving averages, some investors use the 10-day crossing above the 50-day as a technical indicator.
Right. Now, in the last segment, we just talked about how when the 10-week moving average gets above the longer-term 40-week moving average, that's a sign of strength. Now, it's the same concept on a daily chart when the 10-day line gets back above the longer-term 50-day line. And here's where that happened for Disney in October as it was building the right side of a new base. And from there, the stock, for the most part, stayed nicely above that 10-day line.
And notice that the 10-day line continued to move higher, and it did so in a nice, tight price movement. That's what you want to see, nice tight price action. Now, November the 4th, it fell below the 10-day line, but the 10-day line was still comfortably above the 50-day.
Right. Then on November 27th, Disney fell below that line, and it has stumbled as the general market overall has come under pressure. But Amy, in your book, some of the folks that you interviewed, they were using that initial crossing of the 10-day going back above the 50-day as a pretty aggressive early entry.
It is aggressive. Now, with Disney, that would have happened right here, and this is the stock's 10-day moving above the 50-day. Now, if you use this strategy, you've got to keep your sell rules. If the trade starts to go against you, this is a more aggressive buying. I would also like to add that early strategies work much, much better in a strong, uptrending market.
Now, Kihu shows another example of this in action. You've got the 10-day line climbing back above the 50-day in mid-October, and like with Disney, it climbed nicely above that line from there. But as Amy, as you just said, using that as a buy signal is a very aggressive, more advanced strategy. And not all stocks are going to move like Disney and Kihu and just keep going up that line. Some of them will just drop back below it. So we're not recommending this, but just pointing out how some investors do use this. But as you said as well, you better have very solid sell rules and, just as importantly, the discipline to follow them.
To stick with it, yes, absolutely. Now with Disney, when the 10-day rose above the 50-day, the trading was nice and tight, extremely tight. Same with when we saw Disney, Kihu, same thing. Kihu stayed above the 10-day or hugged it as it moved higher. And again, look at that nice, tight price action. And notice also that the spread was getting wider between those two moving averages.
Right. Now, again, these types of more aggressive strategies, they work better in a strong uptrend, right? And they become increasingly risky in a market that is coming under selling pressure.
We have a special section this week. It's a retirement section, so you can find that on our website.
Right, and you'll find that at investors.com/investing show. And while you're there, please do check out the latest issue of the free IBD Extra newsletter.
Okay, see you next week, everybody.